The cycle I witnessed resulted from my observation of three significant forces that had occurred numerous times in history, yet I had not encountered them during my lifetime. This prompted me to study the last 500 years of this cycle. Firstly, when governments exhaust their funds and require more money than they can acquire, they tend to print large amounts of money, leading to the largest debt increases and money creation. This has particularly been the case with leading reserve currencies, such as the dollar, euro, and yen. The second force is political and social, and arises from the conflict between the left and right populism, typically caused by the significant wealth and opportunity gaps that exist in the United States. This conflict has escalated to almost a civil war as representatives fight for their ideologies rather than seeking compromise. These ideological, economic, and political differences can be observed daily in the news, and they were particularly highlighted by the events of January 6, where neither side accepted the outcome of the election. We often observe manifestations of loss, such as in the recent Supreme Court ruling on abortion. This type of conflict is significant and can be measured as the most substantial since 1900. Another notable change is the relative decline of the United States and the rise of other nations, particularly China and India, resulting in a shifting global order. Historically, world orders emerge after wars, and the victors determine the new structure. In 1945, after winning the war, the United States held the world's largest economy, gold reserves, and military power, making it the dominant world power. This led to the establishment of global institutions such as the United Nations, IMF, and World Bank in the US. However, the US's relative positioning has since declined, while China has emerged as a great power, resulting in a new global power dynamic. Throughout history, competition has often led to conflicts, with 5 types of wars emerging: trade, technology, geopolitical influence, capital, and military wars. We are currently experiencing a difficult period, similar to the one between 1930 and 1945, as a result of these various forms of competition. As a global macro investor, it is crucial to understand the impact of these conflicts on positioning today. It is advisable to avoid debt assets that are subject to inflationary pressures, and to create a well-balanced, diversified portfolio of assets that perform well during times of inflation. Diversification is crucial to maintain good returns while minimizing risks. This includes country diversification, as all currencies are now fiat currencies. ND tend to be related to each other. In this environment of relative depression, no country wants to see its currency appreciate too much, resulting in a fair amount of money printing. There will be a temporary period of tightening in monetary policy over the next 6 to 12 months, which will produce weakness in markets, followed by weakness in the economy and another round of easing. As a storehold of wealth, such investments will not bring interest rates. While typing, it's important to aim for a level that compensates for inflation, so that you don't lose money due to its effects. This is why it's often better to invest in inflation hedging assets, rather than traditional currencies. While we tend to think of currencies in relation to each other, they all have this inflation issue. Non-fiat currencies, like gold and digital currencies, which are newly developed, are becoming increasingly popular. The next few years will likely see a lot of confusion and competition between different currencies, with less attention being paid to fiat currencies and more to others. However, the dollar will still be important, and the RMB may become more significant. Gold is an interesting example of a non-fiat currency. It usually has a low return, but it's a limited supply asset that's essentially a store of value. Unlike equities, which are subject to constant invention and productivity, gold doesn't change much. It's important to own gold during certain times, such as times of conflict or inflation, when it can act as a hedge against these risks. However, at other times, it can be a dead asset and not produce much a return. In the current environment of high debt and money creation, gold is likely to be a good investment, but it should not dominate a portfolio. A 15% allocation to gold might be appropriate. Other assets, such as cryptocurrencies, can also diversify a portfolio. Bitcoin, for example, has been around for 11 years and has not been hacked. However, the total value of all Bitcoin is still less than the value of Microsoft, and the gold market is also relatively small. If you exclude central bank reserves and jewelry, the gold market is about 5 times larger. However, it has its own set of issues such as traceable transactions and privacy concerns, and can be shut down or made illegal. I don't think gold will be held as central bank reserves for various reasons. It is said that gold is the only asset that you can own without waiting for a payment from someone else, making it less vulnerable to political or other forms of confiscation. But we are in a new environment where the ability to transact with an asset anywhere in the world is important, making digital currencies a good competitor. In terms of indicators, the cost of an educated person and levels of indebtedness are good indicators for growth. India has a relatively good level of indebtedness and a highly educated population, making it projected to have the highest growth rate of any country over the next 10 years. With improvements in infrastructure and bureaucracy underway,